Hello, everyone, and welcome back to the Deep Dive. I hope you're having a fantastic week and are ready for another, well, deep dive.
Absolutely.
Today, we're breaking down one of the most, frankly, paradoxical companies out there, Philip Morris International, or PMI.
Yeah, it's a fascinating one.
On the surface, it's this absolute giant, a cash machine built on tobacco. But the real question for us as long-term investors is this. They're spending billions, over $14 billion actually, to pivot away from cigarettes towards smoke-free products. Is this massive bet creating a genuinely more durable business, or are there hidden cracks in this transformation that the market might be ignoring? That's what we're here to find out.
That's a massive question. And before we get into the nitty-gritty, just a quick note for everyone watching.
For those who want to act on these investing ideas, having a professional-grade platform is key. We use Interactive Brokers, and we've partnered with them to get our viewers a stock bonus when they sign up.
So I get a bonus and support the channel at the same time. That link is in the description, right?
That's right. And of course, if you find value in this kind of in-depth discussion, the best way to let us know and to get the next one is to subscribe and like the video. It truly helps the channel. And if you have any questions regarding the company, please manifest yourself in the comments section.
Perfect. Now let's get into it. Pillar number one, the business model. Or maybe we should call it the dual business model.
Yeah, exactly. Let's jump right into that first section and define this this new operational structure, because you really can't look at PMI today as just a cigarette company anymore. You've got to see it as this, well, dual engine machine.
That dual engine analogy is perfect, actually, because they are moving in fundamentally different directions, but, working together, for now at least.
Okay, so break down these two engines for us. What are their roles?
All right, so engine one, that's the legacy business. Think combustible tobacco. Think Marlboro. It's high margin. It's predictable.
The cash cow.
The ultimate cash cow. Its main job right now, generate enormous amounts of profit and free cash flow. But, and this is the big but, we have to be clear, it's in secular volume decline globally. It's shrinking, slowly but surely.
So it's the funding mechanism. It's paying for the future.
Precisely. It's the golden goose, laying the eggs to fund engine two.
And engine two, that's the future, the big bet.
That's the growth engine. The smoke-free products, or SFPs, and this isn't just, adding a couple of new products. This is a massive strategic portfolio shift.
A fundamental transformation.
Absolutely. And the SFP portfolio itself has sort of three main pillars driving it. You've got the flagship, IQOS. That's their heated tobacco platform, an electronic device needing its own special consumables.
Right, the heat not burn tech.
Exactly. Then there's ZYN, that's the oral nicotine pouch phenomenon, which they got hold of by acquiring Swedish Match. A really key move.
Huge acquisition.
And finally, there's VEEV, their e-vapor products. So they're covering the main alternative nicotine bases. But it's the sheer scale, the commitment here, that really sets PMI apart from, well, pretty much everyone else.
And that scale, it's worth putting numbers on it again. Over $14 billion invested since 2008. Just focused on R&D, scaling up manufacturing for these less harmful alternatives. I mean, that's a statement, right?
It dwarfs most R&D budgets, full stop. And it's not just spending. We're seeing the results, the tipping point. The shift is happening, maybe faster than a lot of people expected.
What kind of numbers are we talking about?
Well, think about this. By the second quarter of 2025, SFPs already made up 41% of PMI's total global net revenues. 41%. That's getting pretty close to parity with the old cigarette business.
Wow. In just over a decade, basically.
Yeah. But here's the real kicker. The data point that really shows the strategic shift is real. By the end of 2023, the net revenues coming specifically from the IQOS platform, it already surpassed the revenues from Marlboro.
Okay, stop there. That's huge. Marlboro, arguably one of the most iconic global brands ever created. Synonymous with cigarettes for, what, 50, 60 years?
Easily. And now, a product platform, IQOS, that's barely 10 years old in most markets, is bringing in more top-line revenue. It's a tectonic shift. It proves this whole pivot isn't just talk. It's actually happening on the ground, in the numbers.
And the ambition doesn't stop there. They're aiming for over 2/3 of net revenue from SFPs by 2030, with this ultimate goal of just phasing out cigarettes completely.
That's the stated mission, phasing out cigarettes entirely. Which brings us to what you call the complexity paradox, because, intuitively, moving from making simple things, paper, tobacco leaf, to making sophisticated electronic devices, dealing with firmware, complex supply chains, that sounds more risky, right? Not less.
Yeah, how does making things more complicated make the business more durable? Seems counterintuitive.
Well, that's the crux of the analysis. Why does complexity potentially equal durability in this specific case? Think about the old model.
Mm.
Simple, yes. Highly profitable, yes. But it faced an existential threat, precisely because it was simple. High profits, but absolutely zero defense against public health campaigns, regulations, social stigma. The product itself was, well, chemically simple, but politically toxic.
A massive target for regulators everywhere.
Exactly. Now, contrast that with the new model. High-tech devices, proprietary heat-not-burn technology, carefully formulated nicotine pouches. It becomes defensible because it creates higher barriers to entry technically, operationally. Competitors can't just jump in easily. They need serious expertise now.
And things like microchips, battery tech, software patents, not just blending tobacco.
Right. So the sheer capital needed, the R&D spend to master device engineering and nicotine science, that becomes a moat in itself.
Right.
But you also mentioned the regulatory angle. How does complexity help there? Because regulations are usually seen as a negative.
Yeah, how does that work?
Because they can finally address the core criticism head-on. Combustion. By moving away from burning tobacco, they can now go to regulators, the FDA in the US, health ministries across Europe, Asia, and engage on the basis of harm reduction.
Ah, so it changes the conversation.
Completely.
Yeah.
They can present data, loads of data, collected from their devices, showing usage patterns, showing reduced levels of harmful toxicants compared to cigarettes. This allows them to potentially secure a more stable, long-term operating environment because they position themselves as part of the solution to the smoking problem, not just the cause.
And getting those specific regulatory approvals, like the FDA's MRTP status, that's a skill in itself.
It's a massive advantage. That regulatory know-how, navigating those complex processes country by country, becomes an irreplaceable asset. It's a form of moat, too.
So they basically turn a massive vulnerability regulation into a potential competitive strength. The underlying demand for nicotine doesn't disappear, but the way they deliver it becomes proprietary, patent protected, and crucially, a bit more acceptable to health authorities than just selling cigarettes.
You've got it. They're swapping out a simple, dying, politically indefensible cash cow for a complex, regulated, technologically locked-in growth engine. It's actually, well, it's a pretty elegant strategic maneuver when you unpack it.
Okay, that makes sense. Let's shift then to Section 2, the bedrock of their historical strength, the economic moat. We always think of brands, addiction.
Yeah.
How's that evolving as they move into electronics?
Well, the foundation absolutely is still those powerful intangible assets.
Right.
Marlboro. It's still the world's #1 international cigarette brand. It provides that incredibly predictable, powerful cash flow, even with volumes gently sliding. That brand equity is the strategic war chest funding the whole pivot.
But the execution, the really impressive part, has been their ability to replicate some of that brand power in the new SFP categories, right?
Yes. Look at IQOS. Where it's established, it's rapidly become the #2 tobacco brand overall. It's created this immediate high-value connection with millions of users very quickly.
Almost like a tech product adoption curve.
In a way, yes. And then there's ZYN. Let's not understate the genius of buying Swedish Match to get ZYN. It's not just another nicotine pouch. It's the dominant global brand in that category, which is itself growing incredibly fast.
So they bought the leader in a high-growth segment.
Exactly. Establishing brand dominance early in these new categories is crucial because it builds loyalty and, importantly, switching costs for this next generation of nicotine users.
Okay, so brand is still key, but the ultimate test, the acid test for any economic moat, isn't just brand feel, it's pricing power. Real empirical pricing power. How does that look, especially in the legacy business, the one that's supposed to be dying?
This is honestly one of the most stunning financial aspects of PMI. You look at the combustible cigarette business, volumes are declining, okay? We know that. Yet PMI managed to achieve 5.9% organic net revenue growth in that segment recently.
Wait, hang on. Revenue growth in a declining volume business. How?
Price, almost entirely price. That 5.9% growth was driven by an 8.7% increase in prices.
8.7%.
Yeah. Think about what that means. You have a product category in long-term structural decline, yet they can jack up prices way, way above inflation, like 2 or 3 times the normal rate, and people still buy it. They don't lose catastrophic market share.
That proves incredible demand inelasticity.
Absolutely profound. It speaks volumes about the power of the brand, yes, but also the underlying physiological addiction loop. Consumers are anchored to the product.
So they're effectively harvesting the legacy business, milking it very efficiently to fund the transition. But the pivot itself, the move to SIPs, is actually building new layers of defense, right? The switching costs you mentioned.
Exactly. This is where the technological moat comes in. The IQOS ecosystem. It's a closed system. It's proprietary. You buy their specific device.
The IQOS device itself.
Right. And that device is engineered to only work with their proprietary consumables, the heats or the newer Turia sticks. They've got, what, over 32 million users now, locked into that specific hardware and the recurring purchase of those sticks.
That's a significant number. So if I'm an IQOS user and maybe a competitor comes out with a different heated tobacco device, I can't just switch the sticks I buy?
Nope. You have to ditch your IQOS device, shell out cash for the competitor's hardware, learn how it works, maybe deal with a different taste or experience.
It creates real friction, monetary cost, behavioral cost.
Significant switching costs, both money and hassle. It's basically an ecosystem play, just like you see in the tech world. Think Apple, maybe?
Oh.
They control the hardware, they manage the user experience through software or firmware updates, and crucially, they control the high-margin, recurring revenue stream from the consumables. It's a beautiful business model loop, frankly.
A modern consumer staple model.
You could call it that.
Yeah.
And when you start layering all these factors together, the old brand moat, the addiction, the pricing power, plus these new technological switching costs, plus the global scale, you get what Charlie Munger famously called the Lollapalooza effect.
Ah, the convergence of multiple advantages multiplying each other.
Exactly. It's not just additive, it's multiplicative. These forces work together to create this really formidable competitive position.
So let's break down those converging forces for PMI specifically. What are the key elements creating this Lollapalooza effect?
Okay, I think we can identify 4 primary ones. First, as we said, powerful branding and loyalty. Decades of Marlboro mean premium pricing power even in decline. And the new brands, IQOS and ZYN, they achieve premium status and mindshare almost instantly. That's huge.
Okay, brand power, what's second?
Second, the inescapable foundation. Physiological addiction. Nicotine is highly addictive. That ensures the revenue stream is incredibly reliable, recurring, and, as we saw with the 8.7% price hike, highly inelastic. People don't just walk away easily.
Right, addiction underpins the pricing power.
Third, and this is where their sheer size comes in, massive global distribution. They spent over half a century building this incredible network. Supply chains, relationships with millions of retailers, kiosks, distributors, reaching over 180 countries.
An insane footprint.
It's a massive barrier to entry. A startup, even one with a better mousetrap, simply cannot replicate that physical global reach quickly, or maybe ever.
Okay, brand, addiction, distribution. What's the fourth force?
The fourth, which we touched on but really needs emphasis, is that regulatory know-how. Their deep institutional expertise in navigating incredibly complex, often hostile, and constantly shifting regulatory landscapes worldwide.
Managing taxes, flavor bans, product approvals, marketing rules across 180 different sets of rules.
It's a unique, almost impossible to replicate skill set. It's a competitive advantage in itself, being able to operate effectively in that environment.
So you put it all together. The brand makes the addictive product desirable, the distribution makes it available everywhere, the ecosystem locks users in, and the regulatory skill protects the whole system.
It's a stunning convergence. It really confirms that this is a business with, deep, deep competitive quality.
Okay, before we dive into the financials and management, let's do a quick reality check on execution. A high-quality business, especially one going through such a massive internal upheaval, needs things to be running smoothly. Happy customers, motivated employees. What's the word on the street? The scuttlebutt about how things are actually working day to day.
It's interesting, actually. It reveals a bit of a dichotomy. On the customer side, especially for the growth brands, sentiment seems quite polarized.
How so?
Well, take IQOS. You hear a lot of praise users saying it's cleaner, it's a satisfying alternative to smoking. But there's also this persistent, quite vocal minority complaining about device reliability issues. Devices breaking, frustrating customer service experiences, mechanical failures.
That doesn't sound great for a premium electronic device.
It's not ideal. The good news, though, is that the company seems aware and is clearly investing to fix it. The newer IQOS Lumaya models, for instance, seem to address a lot of those core reliability complaints. It shows they're listening and iterating, which is positive.
And what about ZYN? That seems like the golden child.
Oh, overwhelmingly positive. Users love the convenience, the discretion, the flavor variety, the consistent nicotine hit. ZYN just nailed the product market fit. That acquisition looks smarter and smarter. They bought something simple that customers just immediately loved.
Okay, so some friction with IQOS hardware, but ZYN is a hit. What about inside the company? The employee perspective. The data suggests it's a great place to work, high marks, but also hints of pressure.
Yeah, the headline numbers look fantastic. You see these 93, 94% favorable reviews overall. People rate the compensation, the benefits, the team atmosphere really highly. They clearly attract top talent, partly with good pay, but also with this compelling mission, working towards a smoke-free future. It's quite motivating for many.
There's always a but.
The but is the pressure. You see persistent negative feedback themes around burnout. A really striking number is something like 67% of employees reporting feeling burnt out. That's high.
67%! Wow.
And alongside that, you get consistent, sometimes sharp feedback about the senior leadership culture. People use phrases like pressure cooker environment, mention huge egos at the top, and a sense that dissent isn't always welcome, that dissenters get dismissed.
That qualitative stuff, that feels like a significant long-term risk, doesn't it? Especially during a complex pivot. A culture that shuts down dissent can develop huge blind spots. And burnout can just cripple execution when you need precision most.
Absolutely. It points to this internal tension. You've got the operational teams seemingly executing the mission well, but potentially under unsustainable pressure from leadership who are maybe juggling the demands of the ambitious smoke-free future with the quarterly targets still driven by the legacy business. That puts enormous strain on the middle layers.
Something to watch closely. Okay, let's move to Section 3, Management, Stewardship, and Financial Resilience. This kind of massive transformation needs more than just a vision. It needs really disciplined execution, especially with capital. What's the philosophy coming from the top, from CEO Jacek Olczak?
Olczak's message is crystal clear, and it's entirely focused on the transition. His whole narrative is about securing the company's long-term viability, its earnings power, its dividend growth, by making the SFP pivot successful. He's been explicit. The legacy cigarette business is important now, but its continuation is basically subordinate to the success of Engine 2.
The future is SFPs, full stop.
That's the stated philosophy. And the crucial proof, the thing you always need to check, is whether the incentives align with that philosophy. Are they actually paid to prioritize the pivot?
Right. Talk is cheap. How is management compensated?
Well, this looks like a pretty good example of aligning pay with long-term strategy. A significant chunk of executive compensation is tied up in long-term equity awards, and these awards are linked to something called a transformation performance metric.
Okay, what goes into that metric?
It specifically includes KPIs directly related to the pivot. Things like hitting SFP adoption targets, increasing smoke-free shipment volume. So they're not just rewarded for overall profit growth, which could incentivize milking the cigarette business. They are explicitly rewarded for phasing out cigarettes and growing the SFP side.
So their bonuses literally depend on executing the strategy they're talking about.
It seems like a very strong alignment mechanism. It reduces the risk that they'd prioritize easy, short-term cigarette profits over the harder, longer-term strategic shift.
Okay, strong alignment. Now, the ultimate test of management quality, capital allocation. Where does the money go? What's the hierarchy?
They seem to follow a pretty rational, disciplined approach. Priority 1 is organic reinvestment, specifically into the SFP engine.
Pouring money back into Engine 2.
Exactly. Look at their planned Capex for 2024 to 2026, somewhere around $3.5 to $3.7 billion. About three-quarters of that, 75%, is earmarked specifically for SFP projects. Scaling up manufacturing for devices and consumables, R&D for next-gen products, building out the complex logistics needed for electronics.
Okay, reinvestment first. Priority 2 must have been the big M&A deal.
Yes, the strategic acquisition of Swedish Match. That was all about accelerating the transformation. They paid a hefty price, no doubt, but you can argue it was rational because it instantly brought the dominant ZYN brand into their global portfolio.
Giving them immediate leadership in the fast-growing pouch segment.
Right. It probably accelerated their SFP transition by several years and gave them a strong foothold in a key market outside heated tobacco. A strategic masterstroke, potentially.
Okay, reinvestment, strategic, M&A. What's priority 3? Shareholder returns, dividends, buybacks.
Shareholder returns are clearly important. They have a stated commitment to a progressive dividend policy, targeting paying out around 75% of their adjusted earnings per share as dividends. That's a core part of the investment case for many.
A reliable dividend payer.
But the really telling detail, the thing that signals strong discipline right now, is their stance on share buybacks.
What are they doing there?
They've put them on hold, explicitly. Management has stated they will not resume share repurchases until they've deleveraged the balance sheet back down to their target net debt to EBITDA ratio.
Okay, let's unpack that. Net debt to EBITDA, that's basically a measure of leverage, how many years of operating profit it would take to pay off all the debt. They took on debt for a Swedish match, right?
Correct. After the acquisition, that ratio jumped up to around 3.0x. Now, for a company like PMI with huge, stable cash flows, 3.0x isn't necessarily dangerous, but it's maybe a bit higher than ideal. It could limit flexibility, maybe worry the rating agencies a little.
So what's the target?
Their target is 2.0x. Getting back down to 2.0x is a much more conservative, comfortable level. It signals they're prioritizing strengthening the balance sheet, paying down that acquisition debt, over using cash for buybacks right now.
Which shows discipline. They're not trying to artificially boost the share price with buybacks while the balance sheet is stretched.
Exactly. It protects the dividend safety and ensures they have financial firepower if another strategic need or opportunity comes up. It's prudent.
That does sound like robust capital discipline. Okay, let's put some hard numbers on the quality of this business. When you look at the key financial ratios, what confirms this isn't just big, but actually an exceptional company?
Two key metrics really stand out: return on invested capital, ROIC, and free cash flow, or FCF, conversion. Historically, PMI has been a phenomenal capital allocator. Its ROIC has consistently been well above 20%, often even pushing above 30% in the past decade.
And that 20% ROIC level is sort of the benchmark for a high-quality business, right? It means for every dollar they reinvest, they're generating over 20 cents in annual profit, significantly more than their cost of capital. They're creating real economic value.
Precisely. And even now, with all the massive investment going into SFPs, building factories, R&D, and after paying that big premium for Swedish match, their current ROIC is still holding up impressively well, somewhere in the low 20s.
So the new investments are also generating good returns. They're not just throwing money away.
It appears the investments are productive and value accretive, yes, which is crucial for the thesis.
Okay, high returns on capital.
Right.
What about the cash generation itself? You know, profits can be managed with accounting, but cash is king. How good are they at turning profits into actual cash?
They are an incredibly efficient cash machine. We look at FCF conversion. What percentage of their reported net income actually turns into free cash flow that the company can use? Over the last 10 years, PMI's FCF conversion rate has averaged over 120%.
Whoa, over 120%. How is that even possible, and why is it such a strong signal?
It's possible because their working capital needs are very low, almost negative in some ways. Think about it. Cigarettes, and now increasingly the heat sticks and pouches, are fast-moving consumer goods. They sell quickly. They collect cash from distributors rapidly. They don't have vast amounts of cash tied up for long periods in inventory, sitting on shelves or waiting for customers to pay invoices, unlike, say, a heavy industrial manufacturer.
So the cash comes in almost as fast or faster than they book the profit?
Pretty much. It means the reported earnings are very high quality, not dependent on accounting assumptions, and the cash is immediately available for dividends, paying down debt like we discussed, and reinvesting back into the business. That high cash conversion makes their plan to deleverage back to 2.0x EBITDA entirely believable and achievable.
Okay, picture painted. High quality, well-managed, disciplined, financially strong company executing a massive pivot. But investing is always about the future. Let's move to section 4. Growth engines, catalysts, and those ever-present permanent risks.
Right. The primary growth engine, fundamentally, is just the continued global adoption of their SFPs. It's about converting as many of the world's roughly 180 million adult smokers outside China as possible over to IQOS and ZYN, which are higher margin and theoretically more sustainable products. Success is measured by that conversion rate.
But are there specific events or triggers, near-term catalysts, that could really accelerate things or unlock value in the next, say, 1 to 5 years?
Yes, there are two really significant ones on the horizon. The first is potentially enormous, the full-scale commercial launch of IQOS in the United States.
Ah, right. They had that deal with Altria that ended, and now PMI has the reins in the U.S. market itself.
PMI now fully controls IQOS commercialization in the U.S., and the U.S. remains the largest, most profitable nicotine market in the world. Getting their flagship heated tobacco product launched properly into that massive market.
Yeah.
That's a multi-year growth runway that you could argue isn't fully baked into the share price yet because the nationwide rollout is still just beginning. It's like opening up the biggest prize territory for their new engine.
Huge potential there. What's the second catalyst?
The second leverage is that Swedish match acquisition, taking ZYN global.
Replicating the U.S. success internationally?
Precisely. ZYN has been an absolute phenomenon in the U.S. oral nicotine pouch market, incredible market share, cultural penetration. The catalyst now is for PMI to use its massive, unparalleled global distribution network, something Swedish Match didn't have on the same scale, to roll out the ZYN brand across key markets in Europe, Asia, Latin America, everywhere.
If they can capture even a fraction of the U.S. magic internationally.
It provides another powerful growth vector, another way to really make that expensive acquisition pay off handsomely.
Okay, strong potential catalysts.
Yeah.
But we have to confront the bear case, the shadows hanging over this. What are the permanent impairment risks? The things that could genuinely break the thesis, derail the pivot permanently?
There are two main ones, I think. The single biggest, the truly existential threat, is adverse regulatory and taxation convergence.
Meaning governments stop treating SFPs differently from cigarettes.
Exactly. The whole economic rationale for the SFP pivot rests on this idea that governments will continue to provide a regulatory off-ramp, lower taxes, fewer restrictions for these theoretically less harmful products compared to combustibles. If that differential disappears.
If governments suddenly decide, nope, nicotine is nicotine, tax it all the same, ban all the flavors, restrict marketing just like cigarettes.
Then the SFP growth engine loses its economic advantage. The higher margins shrink, the appeal diminishes. The entire $14 billion plus investment rationale gets severely damaged, maybe even destroyed. If the tax and regulatory arbitrage goes away, the structure could potentially collapse.
That's the sort of Damocles hanging over them. What's the second major risk?
The second is technological disruption or a major execution failure. Look, PMI is the leader now in heated tobacco with IQOS and in pouches via ZYN. But this is a fast-moving tech space, weirdly enough.
One could build a better mousetrap.
It's possible. A competitor, maybe another big tobacco player, maybe a startup, maybe even a pharma company focused on cessation, could potentially leapfrog IQSS or ZYN with a technology that's demonstrably safer, or just delivers nicotine more effectively or satisfyingly. That could erode PMI's tech moat pretty quickly.
And we talked about the execution pressures earlier, the burnout, the leadership culture issues. A big stumble there could be fatal too, right?
Absolutely. Imagine a major global recall of IQOS devices due to a safety issue, or a massive supply chain meltdown as they try to scale up complex electronics manufacturing globally. That kind of execution failure could permanently damage the brand's reputation, not just with consumers, but critically, with regulators.
And losing regulatory trust in this game, that could be game over.
It would be incredibly damaging, potentially erasing their leadership position overnight.
Okay, so let's try some second-level thinking here. We've laid out the consensus. High-quality company, impressive pivot, but significant risks. Where might the market be getting it wrong? What's a contrarian angle, maybe bullish or bearish?
Okay, let's start with a potential bullish contrarian take. I think there's an argument to be made that the market consistently underestimates the sheer resilience and cash-generating power of the legacy combustible business.
So everyone focuses on the volume decline, but misses the underlying strength.
Exactly. They see shrinking volumes and mentally write it off faster than they should. But they might be underweighting the impact of that incredible pricing power we discussed, the 8.7% price hikes. That slow, managed, highly profitable decline isn't just a weakness. It's a strategic asset.
It's the funding engine that just keeps on giving.
It's a reliable, predictable source of massive cash flow that funds the dividends, pays down debt, and fully subsidizes the entire SFP transformation for potentially much longer than pessimistic models assume. The longevity and profitability of the legacy business might be the ultimate financial safety net that the market underappreciates.
Interesting. The dying business is actually the key financial buffer. Okay, what about the other side? A bearish contrarian take. Where might the market be too optimistic, too complacent?
I think the complacency might lie in the assessment of the long-term regulatory risks, specifically for the SFPs themselves.
So the market accepts the current regulatory difference between cigarettes and SFPs, but assumes it will last.
Kind of. The current valuation, which reflects PMI's quality and the SFP growth story, seems to implicitly assume a relatively stable, favorable, and differentiated regulatory environment for SFPs stretching out for many years, maybe indefinitely.
But the bearish view is that this is naive.
The bear case warns about the slippery slope. The same societal and political forces that successfully prosecuted the war on smoking might not just stop neatly at eliminating combustion. That momentum could easily morph into a broader war on nicotine in all its forms, especially flavored, easily accessible forms like pouches or vape products.
So the very things that make SFPs appealing to users and profitable for PMI, the flavors, the lower taxes, the less stringent marketing could become the next targets for regulators.
Precisely. If the political winds shift, and the consensus becomes nicotine itself is the problem, regardless of delivery method. Then you could see governments start treating ZYN pouches or IQOS sticks much more like traditional cigarettes, hiking taxes massively, banning flavors that are key to adoption, restricting visibility.
And if that happens, the entire transformation thesis, the whole $14 billion bet, just evaporates. The growth premium built into the stock disappears overnight.
That's the ultimate terminal risk that maybe isn't fully priced in. Is PMI building a genuinely permanent new moat based on harm reduction, or are they just buying themselves maybe 10, 15, 20 years of temporary regulatory arbitrage before the hammer falls on nicotine itself?
It really boils down to that regulatory endgame, which brings us neatly to our synthesis. What we've seen is that PMI is undeniably a high-quality operation, great returns, disciplined management, executing a hugely ambitious pivot pretty darn well so far. But the outcome for you as an investor hinges entirely on two things.
Right. First, the price you pay today. Does the current valuation offer enough margin of safety? And second, your judgment on the duration and stability of that regulatory advantage granted to SFPs. How long will governments let them operate under different rules?
The analysis confirms, using the Buffett framework, that PMI is likely a wonderful company. Great economics, strong position. The final hurdle, the tough part, is figuring out if it's trading at a wonderful price that adequately compensates you for both the potential upside of the SFP growth and those significant, possibly terminal regulatory risks inherent in selling nicotine, period.
It's a classic quality versus price dilemma, complicated by this massive strategic pivot and regulatory uncertainty.
Exactly. And that leads us to our final provocative thought for you to take away and wrestle with. We know PMI is betting the entire farm, billions and billions of dollars, on the belief that safer nicotine delivery is a socially acceptable, commercially viable, and permanently defensible business model. They are executing on that belief with immense resources and skill. The key question for you to really mull over is this. Is this monumental pivot truly building a sustainable, long-term moat against inevitable decline, or is it ultimately just a very sophisticated, very expensive, temporary refuge from a powerful societal and political tide that might, in the end, aim to eliminate nicotine altogether in all its forms?
Think about that durability. Is it real or just borrowed time?